Did you know if you invest in cryptocurrency in Australia and make a profit, you actually have to pay tax? Well, if you didn't today, I'm going to share with you the information that you need to know as an Australian crypto trader. How's it going, guys? Ryan here and welcome back to another investing video, and today we're talking about cryptocurrency tax within Australia and what you have to do in order to comply with this tax legislation. But before we get into that, guys, please remember to give this video a thumbs up. It helps me out so much with the YouTube algorithm, and subscribe if you want to see more stock market investing and wealth management type content. We cover all that cool stuff and much more on the channel. I'd love to know your thoughts on cryptocurrency in the comments section below. And without further ado, guys, let's get straight into the video. Cryptocurrency has been and is becoming an even bigger craze at the moment, with lots of new people getting involved in trading and buying cryptocurrencies, and with that comes a lack of information with regards to the fact that there are actually tax rules involved here. As a result, a lot of people are actually not following the ATO's guidelines and legislation, and as a result, they're technically breaking the law. So today I want to share with you what the rules are in place with regards to cryptocurrencies within the tax realm of Australia. So just to kick it off, cryptocurrencies are classed as a form of asset. So they're classed as effectively property. They're not technically considered a currency, but rather they're more considered something like a stock. So it's effectively an asset in its own right. As a result of that, the appropriate tax legislation that comes into play is capital gains tax. And if you've seen my other videos on stocks, it's effectively similar to this, but it isn't actually exactly the same due to the fact that there are a couple of different events which differ from your typical capital gains tax events, which are unique to cryptocurrency. And now I'm going to go through those 4 types of events with you. The 4 key types of capital gains tax events are as followed for cryptocurrency. Number 1, if you sell or gift a cryptocurrency. Number 2, if you trade or exchange a cryptocurrency, and this includes the disposal of one cryptocurrency for another cryptocurrency. So instead of converting it into dollars, for instance, you're converting it into another crypto. Number 3, if you convert cryptocurrency to fiat currency, which is effectively a currency established by government regulation or law, and this is where we start talking about stuff as Australian dollars or US dollars, anything like that. And the final event is using cryptocurrency to obtain goods or services. So as you'd be aware, you're able to actually, purchase certain items or services with crypto out there. There's a few facilities which allow you to purchase real estate or purchase vehicles using crypto, and that would be the sort of event we're looking at here. So for an individual, it's typically treated in the standard capital gains tax methodology. So effectively, the way it works is if you sell cryptocurrency and make a profit on it, or trade it in some way, shape or form and manage to make a profit off that cryptocurrency, then some or all of that amount may be taxed, obviously depending on what tax bracket you fall into. Now, if you're a business, for instance, it's treated slightly differently, and instead it's not under CGT. Instead, it's actually classed as an income for the business itself. And it's also worth noting that each of your cryptocurrency wallets and their currencies within them are treated as individual assets. So if you've got Bitcoin in one location and you've also got Ethereum in that same location, they are treated as separate assets even though they belong to the same wallet. So let's dive a little bit deeper into some of these key events that occurred. The first of which is exchanging cryptocurrency for another cryptocurrency. And I'm taking these examples from the Australian Tax Office's official website, as well as all the other information. So the first example, as I mentioned, exchanging cryptocurrency for another cryptocurrency. The example is on the 5th of July 2017, Katrina acquired 100 of coin A for $15,000. On the 15th of November 2017, through a reputable digital currency exchange, Katrina exchanged 20 of coin A for 100 of coin B. Using the exchange rates on the reputable digital currency exchange at the time of the transaction, the market value of 100 coin B was $6,000. For the purpose of working out Katrina's capital gain for her disposal of coin A, her capital proceeds are $6,000. So as we can see from this example, Katrina traded 20 of her coin A for 100 of coin B, and in that process had made a gain of $6,000 from the original amount. This $6,000 is what is taxable under CGT regulation, and as a result, tax will need to be paid on this value. The second example I'm going to share with you is where we're treating cryptocurrency as an investment. So as you would with a stock, you buy the cryptocurrency, for instance, and then you sell it for a profit. So in example 2, it is Terry has been a long-term investor in shares and has a range of holdings in various public companies in a balanced portfolio of high and low risk investments. Some of his holdings are producing and some of them are not. He adjusts his portfolio frequently at the advice of his advisor. Recently, Terry's advisor has told him that he should invest in crypto. On that advice, Terry purchased a number of different cryptocurrencies which he has added to his portfolio. Terry doesn't know much about cryptocurrency, but as with all of his investments, he adjusts his portfolio from time to time in accordance with the appropriate investment weightings. If Terry sells some of his cryptocurrency, the proceeds would be subject to CGT because he has acquired and held his cryptocurrency as an investment. Now, what we need to be aware of here is that Terry is taxed if he makes a profit on this investment. If there is no profit whatsoever, then effectively Terry is not going to be taxed because obviously he's not made a capital gain. He's either A, sold it for a loss, or B, he's sold it for the same value he purchased it at, making it a break-even amount. Capital gains tax will only apply when you have made a gain and you owe tax to the tax department. There are some exemptions when it comes to CGT in regards to cryptocurrency. Mainly this focuses on the idea of using the cryptocurrency for personal reasons. So for example, if I purchase something very quickly after converting my fiat currency into a cryptocurrency and then went and purchased the good or service, then effectively this is a personal use event as opposed to a CGT event, and I'm going to share with you an example of that right now. So in this example, Michael wants to attend a concert. The concert provider offers discounted ticket prices for payments made in cryptocurrency. Michael pays $270 to acquire cryptocurrency and uses the cryptocurrency to pay for the tickets on the same day. Under the circumstances in which Michael acquired and used the cryptocurrency is a personal use asset. The key thing to note here is the speed of the transaction. It's not like this individual was holding cryptocurrency for 100 days and then decided to use it in order to purchase something. What's occurred is that this individual has converted his fiat currency into cryptocurrency and then immediately used it in order to purchase the concert tickets. And that is the sort of situation that is known as a personal use asset event. Another situation of where CGT does not apply immediately is when we're talking about chain splits. Now obviously chain split is in reference to when you have a coin, and effectively it splits. So the blockchain itself splits and you receive some additional coins as a result of this occurring. They share the same history, all that sort of stuff. But that chain splitting event is not actually a CGT event. Instead, when you eventually, or if you ever make a transaction from that point afterwards, when you've received those funds, that is when the CGT event comes into play, and I'll share with you an example to illustrate this. Alex held 10 Bitcoin on the 1st of August in 2017 as an investment when Bitcoin Cash split from Bitcoin. Immediately after the chain split, Alex held 10 Bitcoin and 10 Bitcoin Cash. Alex does not derive ordinary income or make a capital gain as a result of the receipt. On the 25th of May 2018, Alex sold the 10 Bitcoin Cash for $4,000. Because the cost base of Bitcoin Cash was zero, Alex makes a total capital gain of $4,000 in the 2017 to 2018 income year for the sale of the Bitcoin Cash. Another interesting event that occurs is the loss or the theft of cryptocurrency. And when we're looking at this, we're talking about the idea of replaceability. So can that cryptocurrency be replaced? If it can be, then effectively it can't be claimed as a capital loss. But if it can't be, so for instance, if you lose one of your private keys and you can't access that crypto anymore, that could be considered a capital loss. So here are some examples of situations where this is considered a capital loss. So if you've lost your private key and it can't be replaced, here are some of the situations where you need to be able to provide evidence in order to display that you're able to claim a capital loss due to the irreplaceability of it. When you acquired and lost the private key, the wallet address that the private key relates to, the cost you incurred to acquire the lost or stolen cryptocurrency, the amount of cryptocurrency in the wallet at the time of loss or private key, that the wallet was controlled by you, that you are in possession of the hardware that stores the wallet, transactions to the wallet from a digital currency exchange for which you hold a verified account or is linked to your identity. So as you can see, the whole world of tax and cryptocurrency combined is actually quite messy and it's quite unique. There was so much dispute in the early stages of this because governments around the world, and in particular the Australian government, did not know how to class cryptocurrencies. They weren't sure if they should class them as a currency, for instance, or if they should class them as an asset. But in today's day and age, we have some clear guidelines which are readily available on the ATO website that you can refer to in order to better understand a CGT event and when it applies and when it does not apply when we're talking about cryptocurrency. And with that, guys, I'm going to wrap up today's video. I hope you did enjoy it. If you did, please remember to leave a thumbs up, and that helps me out so much, guys. I appreciate it so much, all your ongoing support. And if you haven't done so already, please remember to subscribe to the channel. I'd love to know your thoughts on cryptocurrency down in the comment section below. And with that, guys, I'm wrapping up today's video. I hope you have an awesome day. I'll see you next time. Cheers.